Good evening. My name is Chris Sabat. I'm a lawyer and I'm the General Counsel for MacMillan Estate Planning. We're here today to maybe take 10 or 15 minutes to talk about estate freezes and refreezes. And I have a special guest with us. It's Sanjay Naker of Nuvero. He's the managing partner of that firm. And Sanjay's just going to help us today talk about this opportunity in the current economic climate. So the first couple slides intended a little bit in jest, but obviously a serious topic. With the current situation, we have COVID-19, we have depressed oil and gas prices, and we see a lot of government subsidies. And so the question that's always coming to mind is, well, one day, ultimately, how are we going to pay for all of these subsidies? And so, really the theory is ultimately it's going to be in the form of some sort of increased taxation. Likely your estate, it could be in the form of, things like increased inclusion rates for capital gains, elimination of the capital gains preferential treatment, perhaps probate fees on your estate. Ultimately there's going to be the necessity to ultimately raise government tax revenue. So as we turn to the next slide, we're going to talk a little bit about death and taxation. Strictly speaking, if an estate plan is done correctly, typically we don't see any taxes imposed upon the passing of the first spouse. But taxation does occur when the second spouse passes. And Sanjay, maybe you could just give us a brief overview in relation to taxation on the passing of the second spouse.
So on the passing of the second spouse, you have to file your terminal return, and in that return you have to disclose all your normal income, like your registered account, which is taxed at the normal rates, top rate being 50%, and of course any capital gains you have, such as shares of a private company or your registered accounts. So that is usually taxed, the gain is taxed at 24%. So those are the two different sources of income that you generally want to worry about. And today's topic is about reducing and minimizing your capital gains tax.
So when we talk about what is an estate freeze, or if I keep it really high level, what we're talking about here is a technique by which you can limit taxation and ultimately transfer greater wealth to your children or to a charity or some other cause that you hold near and dear. So, next slide, we got a bit of detail around why we freeze, and Sanjay's talked about some of the tax benefits. From an estate planning perspective, what we see is real value in actually defining that capital gains taxation that's going to occur on death. And so, let's assume if, for example, the value of your business on your passing is $10 million, we're able to predict that we have roughly $2.5 million in taxation that's going to be imposed. And we can plan to ensure that those taxes can ultimately be paid without in some way disrupting or maybe even destroying the business, because suddenly there's this need for capital to ultimately pay the taxation that happens on the terminal return. We see some other opportunities that are associated from an estate planning perspective as well. We can start to look at business continuity, succession planning. There's an opportunity that we hear from many of our families to allow the children at least that are participating in the business to get some skin in the game. So, if your son or daughter or maybe multiple children are working in the family business, they can see that any growth in future value is actually being attributed to them, and so they see the value in participating and working in the business, and they don't suddenly see a situation where look, I'm helping mom and dad build this business, I'm helping increase the value, and ultimately my sister or my brother are going to benefit from that, even though they're not participating in that work. Sanjay, are there any other tax benefits that sort of come to mind?
Absolutely. I mean, you mentioned at the beginning what that rate could be potentially down the road. Freezing an estate and in a way that lets you quantify that liability, you can take steps to reduce that liability without any extra tax burden. And so it's generally referred to as wasting your death tax away while you are continuing with your business. That's one thing. Number two is, let's say the government is introducing or going to introduce a law to increase the inclusion rate. Well, you will be well positioned to trigger a 24% rate at that point because you have done that in the past. So there's some some good benefits that would come out of it from an estate freeze to minimize your tax burden.
Okay, thank you, Sanjay. So this is kind of the $1 million question for today. It's sort of why freeze now? The reference is to sort of the perfect storm, and I think what we have happening here in Alberta right now, obviously we have COVID-19, which is causing a fair bit of chaos itself, and then added on to that we have this what's sort of turning into a perfect storm from an estate planning perspective or an estate freeze perspective. We have incredibly low oil and gas prices, and so that's creating challenges for many business owners. Would it be fair to say you can't time the market, but you can time your estate freeze?
Well, I hope this is the bottom for us in Alberta and around the world. I think so. The thing is, if you do an estate freeze and it goes even further down, we'll talk about this, we can always thaw and refreeze. You can never pick the right time, but I would suggest looking forward, this would be a good opportunity for people to freeze their estate.
Yeah. Okay. Ultimately then, at the end of the day, we'll find pretty much the low for the valuation of the business, and the increase in value then defers taxation.
Correct.
Okay,
yeah.
Perfect. So maybe just talk for a minute or two about the mechanics of a freeze. And so if you just bear with me, as if we look at sort of the left-hand side of the slide, that's a representation of today's state. So maybe not necessarily in scale, but let's assume that if we look at the left-hand bar, that the value of the common shares of your business, let's say it's $5 million today. If you don't do anything, assuming growth in your business, we look at the second bar, and let's assume that the value of your business, the value of your common shares grows from, let's say, $5 million to $15 million. Well, upon your passing, what's going to happen is that the taxation that's imposed is imposed on the value of those common shares, the $15 million. And so really what we're doing in an estate freeze is we're taking those common shares that show up on the graph on the left-hand side of the slide, and we're swapping them for special shares or preferred shares, they're sometimes called. And what we're doing is we're taking that $5 million in common shares, exchanging it for $5 million of value in preferred shares. And then what happens is, going forward, that $10 million in growth for the new shares that are issued is growing in the hands of the new owner. It could be a trust, it could be your children personally. There's many different options, but the point is, by swapping common shares for this fixed value of preferred shares, we're defining the taxation on your passing. And so that's where we're defining that tax liability, and that's where the opportunity comes to defer taxation for what could be quite easily an entire generation. As we turn to the next slide, you're in a situation where you've done an estate freeze, and because of the downturn in the market, the value of your preferred shares is less than the value of your company. So this is where the opportunity of a refreeze comes in. And Sanjay, can you tell us what the benefits are of a refreeze?
The benefits of a refreeze is that the objectives you contemplated when you first did your freeze are no longer valid. The value of the business is lower than what you froze at. So the act allows you to do it again, essentially. And the steps are not as comprehensive as you went through the first time around, but you will need a valuation report to support a valuation that is lower than your previously frozen value. And if you have that, it's strongly recommended that you do the refreeze so that you capture the lower number. And that's the goal, is to capture the freeze at the lowest point possible. And then you are good. So all your objectives are now continuing to flow into place. The other piece is that, let's say, for example, your preferred shares are equal to the fair market value or not significantly different, then what you do? Well, there might be an opportunity there as well, because sometimes the family trust has a 21-year rule that needs to be looked at, and that's basically a capital gains thing that you got to, every 21 years, you got to deal with that. Well, this could be a time to deal with that, where you can extend the 21-year rule by resetting that and getting a new 21-year rule in place. So those are the key things to keep in mind when we're talking about refreezes.
So maybe we'll just kind of walk through a case study dealing with an initial freeze. Maybe the freeze was 6 months ago, maybe it was a decade ago. I think the opportunity is the same, but maybe we can just walk through this and deal with some of the facts around a freeze. So here what we have is, Mr. Smith did some creative tax planning, some good estate planning. The value of his shares was $10 million. He affects the estate freeze, and obviously the intention is that any future growth will be attributed to his daughter. And ultimately what he's done is defined his tax liability at $10 million with the theory that any growth in that business ultimately grows in the hands of his daughter. Unfortunately, COVID comes along, oil and gas, the collapse in the oil and gas industry comes along. There's an impact to the value of the business, and what we see is the value of Mr. Smith's shares drop by $3 million. So maybe Sanjay, just help us understand here now, how do we do the refreeze?
So a refreeze exercise, without getting into too many details, is essentially fixing the value of the preferred shares that Mr. Smith has to that $7 million value.
Okay.
And then essentially what that does is, right now at this moment, obviously daughter's shares will be worth nil, and so if you anticipate the value to go up to 10 million or 12, all of that growth will happen in the daughter's hands because she is the common shareholder at that point. Typically we have not the daughter but the family trust holding that common share because you have multiple beneficiaries, and if Mr. Smith were to decide to sell the business 5 years from now, for example, and all of her family members were part of the family trust, multiplication of capital gains exemption is available to all of the family members. So now you've captured the $3 million, which is the difference between 10 and 7, and that has now been accrued in the family's hands, and you are able to save taxes on that.
So, and here's the recovery that you're talking about, sort of demonstrated in this slide. So if I understand you correctly, Sanjay, what you're saying is that if we combine kind of this refreeze with a family trust, let's assume that Mr. Smith has four children, we could most likely use the lifetime capital gains exemption for each and every child and actually manage to that's not so much strip, but ultimately the family is going to be able to utilize its lifetime capital gains exemption and not pay any tax on that $3 million in growth.
Correct. Yeah, sorry, I was talking about this on the last slide, but exactly that. In this situation, you are able to use the capital gains exemption for the family that would not have been available otherwise.
As we turn to our final slide, in conclusion, if you're interested in minimizing taxation and transferring greater wealth to your family, this is the time to consider a freeze or a refreeze. And one of the things that we need to consider is that you need an effective date for that refreeze, and that's based on the valuation of your business or of your assets. And so Sanjay, from your perspective, typically, what are we looking at for a time frame in order to obtain a proper valuation? I
would say you're looking at least a month, collecting data and processing and getting a valuation and then implementing the steps. So you need a bit of a lead time, and like you said, if your freeze transaction is dated right in the middle of this crisis, would probably look the best. So I would suggest starting sooner than later.
Okay. So to summarize, at the end of the day, don't wait until you think we're at the low. We need to start to plan ahead and get steps in place so that you're ready to effect a freeze or a refreeze at the opportune time. And remember, we can do all of that work, or at least 98% of that work, virtually. So with that, we'll maybe just open the floor to some questions. And Sanjay, I'd like to just thank you in advance for taking some time to speak with us today.
Thank you.